Hey everyone, CB3 here with another live update on Saturday, August 17th. We had a great week, as you likely know. It certainly was better than the previous week and the week before that at the very end, which led into the August 5th downturn, which proved to be, at least for now, the low of the market. So that's what we're going to talk about today. How did we make this huge recovery? What drove it, and will it hold? CB3 Live begins now. So overall, we had positive earnings and favorable economic indicators. That's what really helped turn the market around. It was a great week for the S&P, the NASDAQ, and the Dow. Sentiment improved, which means investors started feeling better about things as they see the volatility index, aka the VIX, drop. Okay, so the earnings announcements impacted stocks a lot. Some of them were positive, some were negative, like Tesla and Alphabet, i.e. Google, reported underwhelming results, and that led to declines in those two stocks. Tesla, for instance, dropped 11%, but despite that, the market overall was really strong. The S&P was up 4.5% for the week. The NASDAQ was even stronger at 6.2% for the week. This is great to see, and the best week for stocks since November. Remember, though, we're off the highs pretty far because of that downturn August 5th. So what's the technical reason for all this? Well, as I said earlier, it's the VIX. The VIX has reduced. I've given an explanation for the VIX on earlier podcasts. Go back and check those out if you want to understand the VIX better. Also covered it in my latest CB3 Live, which I recommend you watch. That's the August edition of CB3 Live. So the Federal Reserve is in play this week as they head to Jackson Hole, Wyoming for their annual summit. And they won't make an announcement out there. I don't believe that they're going to drop rates in September. It's possible we might have a 50 basis point drop in September, but that could make it look like it's, how do we say, politically driven. Who would ever think that could happen in America? That's really the summary of the week. I want to handle a question that came in. Is manufacturing in a recession? So we have a couple clients that work in manufacturing. One of them is a bigwig at a local company here in DuPage County. And he's wondering if we're seeing signs that this recession looks like any past recessions. And actually, the manufacturing sector generally is what pulls us out of a recession. At least that's been the way over the last 100 years. The manufacturing sector's GDP has declined by 10%. Corporate profits decreased by 53%. Overall GDP contributing to 4% on that. So that just means that manufacturing is pretty susceptible to a recession hitting that sector prior to the general economy. So despite being heavily affected by recessions, the manufacturing sector has often led to a recovery. I just mentioned that. I want to say it again because we go back to the 2000s, 2008, the Great Recession, 2008, 2009, and manufacturers actually experienced recoveries in corporate profits that were 300% higher than those in other sectors. When widgets need to be made, they start getting made and people start buying them because the prices are lower than they were before the recession. So what are the current challenges? The slowdown in the supply chain. So we're still having after COVID effects here 4.5 years later. But unlike past recessions where financial factors were more dominant, the current situation is as much operational challenges such as supply chain issues. And I have a family member who is in logistics, and we still have logistics challenges, although not nearly what they were, with boats stuck out in the Pacific and Atlantic that couldn't even get to shore to unload because of lack of labor. So there are sector-specific impacts like technology and healthcare that have been actually more resilient due to increased demand in those areas, while others have faced significant production decreases and layoffs. So manufacturing is a key member of the 5 sectors of the S&P 500 that are pro-growth, that lead us forward with GDP increasing. That's manufacturing, financials, consumer discretionary, communication services, and technology. Overall, based on the data that I'm seeing, while manufacturing slowing down, it's not in a recession. So that's where it is, guys. I am going to be watching what happens this next week. So in general, it was a really strong week, as I said earlier. So our CG program lost a little bit of ground this week, and that's because we took stops during that downturn. Remember, that's what that program does. It's still beating the S&P 500 for the year, but not quite as much as it was a month ago. GI also holding strong, but obviously can't keep up with the S&P when it has these monstrous strong weeks. DS, on the other hand, which takes no stops, and all of this you guys know that are trading my programs, had a phenomenal week and is doing very, very well because it didn't stop out. We had upturn moves in Meta and some other AI stocks we have that just really propelled the portfolio higher. So let's see what's up ahead. We got the Democratic National Convention this week in Chicago. You guys hang in there, watch for the next update here. I'll probably have an evergreen episode this Thursday, and I'll be back with you live next weekend. If something breaks, though, watch for me, listen for me here, and I'll see you next time. Thanks for listening.